Hello, this is Josh Belk with the Belk on Business podcast. Thank you once again for taking a few moments to listen in today. I think you're going to find today's podcast particularly helpful, especially if you are interested in or you currently have any sort of self-directed retirement plans, or if you're just interested in retirement plans in general. The guest that we have today is truly an individual who has researched this particular topic and actually has a service or a product that I think that will help you and that you'll find great interest in. And we'll get into that a little bit later on this podcast. Sean, a wonderful opportunity to have you joining us today. I'm going to just kind of give you a little bit of a bio on Sean, and then we'll get into some specifics, a little bit more information about Sean, and then we'll get into some specific questions that I think will provide value and just a great deal of helpful information to you. So Saen Higgins, Association for Optimum Achievement, and he's been doing this since 1996, and also QRP, is the world's most sought after teacher and public speaker on the topic of tax deed and tax lien certificate investments. And for those of you who may know Sean, that's probably what you know him from is from that particular past that he has, and maybe even present. You can tell us a little bit about that as well. So he started his career in finance as a stockbroker. I found that interesting. Later became a financial planner and developed his own strategy investing in tax lien certificates. And Sean's passion ranges from assisting clients to build and protect their wealth. And I find this interesting as well. Some of your personal passions of photography and, of course, family as well. And I think that's wonderful. So, Sean, feel free to go ahead and introduce yourself. Tell us a little bit about you and your background.
Well, thank you, Josh. I really appreciate you having me on here today. You know, a little bit of my background is really, kind of culminates with actually what we're going to be talking about here today, which is self-managed pension accounts. I've always been kind of looking at things and going, why is this way? I worked at New York Life. I was going to be a financial planner, basically, with them. I spent 3 years with them. I got Rookie of the Year the first year I went there. And I was really into the whole retirement deal. But what I realized real quickly within that environment is what was good for my clients wasn't necessarily what they wanted me to sell. And it really kind of rubbed, because I came into New York Life kind of in a backwards way. I was a stockbroker that went that way, and that usually those lines don't really cross. And so, I was a hustler, and I went out there and I saw this whole opportunity with pension accounts. Well, what happened was, and I saw this very odd, is if I didn't sell the New York Life product, well, they didn't like that too much. And I started thinking about this. Well, this isn't cool. And then I started looking at outside investments. And that's when I found investing in tax deeds and tax liens on properties back in 1994. I do believe I paid $54 for my first one. 1995, it just went through the ceiling. I did over $5 million in deals that first year, and the rest is history. I mean, I wrote books on that. I had TV shows. I've taught more people worldwide on that subject. But as that was going through that whole process, what I thought was disingenuous was to tell people, oh, I've made my money doing tax lien certificates, when that wasn't true. I did, but I also made money because of the way I set up my retirement account. That became my biggest deal. And so how I got to this point where we're at right now, Josh, is I literally was talking with a mentor of mine who happened to be a CPA like yourself. And he said, what's your biggest challenge for the next year? And I says, you know what? It really is my retirement account. Every time I do anything in my retirement account, they charge me, fees for getting rent checks in there. If I close a deal, it's like a double close. At that time, I think I only had like 3 properties that I did in there, and anything else was just a joke. And he goes, well, why don't you set up a self-managed account? Now, understand my background, Josh. Okay. I was a financial planner at New York Life that I specialized in actually car dealerships, that I would go in there and roll over their retirement accounts. I go, what do you mean a self-managed? And he goes, well, you can be the trustee and you can be the administrator. As soon as he told me that, I knew exactly what I needed to do. So within a week, I had one set up and I started doing my deals in there. It got to the point in 2012, I think it was, I wouldn't do a deal outside of there because the tax saving was so insane. But it also liberated me into whatever I wanted to invest in, which was obviously properties, multifamily, doing stocks. I've got some friends, you and I both know Jeff Tamasulo on Wall Street there, and then cryptocurrencies later on. One of the things that a lot of people don't realize is if you are an administrator and a trustee, you can invest what you feel is appropriate for your particular situation there. So that's really how it kind of got started. I mean, what I found is what's in your best interest as far as a retirement account is concerned isn't in the financial industry's best interest. And I'm not trying to be conspiratorial, Josh, but that's just a plain fact. They want this and they want this only. They want to capture money. Okay. So in other words, they want the account. They know for a statistical fact that 87% of people that set up a retirement account with, whatever, Fidelity, TD, whoever that is, there's a 87% chance they will never change that as long as they don't mess it up. And I'm not even talking about returns. Okay. And what's happened over the years since 1974 is they've programmed us to believe that you actually have to have an administrator to administrate your plan, when in fact, it's the simplest thing in the world. As you know, as a CPA, the way to look at this, wouldn't you agree, is to have a kind of a business approach to it. Your retirement account is your business with a tax favorable advantage on it. You don't have to pay taxes on it, right?
Right. Yeah. It was about 6 months ago. We were at a same event out in the Salt Lake City area. And I remember sitting in the audience and you came up to present. And I remember sitting there, and you and I had not met formally yet at that point. And I remember sitting there and hearing your presentation, and I'm kind of like, Mike, is this real? I remember kind of jotting things down because it was so against all the traditional training that we receive. Okay, you have to have this in place, and this is the way you have to do things, which isn't the way you have to do things. It's just the way that it's in the best interest of those who kind of are the loudest voices in this space want you to think, because it's in their it's in their best interest or in their benefit to do so.
Well, so, let me touch on that a little bit, because you're hitting on something really important. So, I've looked at this very deeply, as you know, since our conversation since then, Josh. And, there is a narrative or an embedded belief in there, because, in reality, in 1974, when the ERISA laws were created, and as you get into the 80s and what have you, even when I became a stockbroker back in 87, and by the way, I became a stockbroker 30 days after the crash in 87. So my timing wasn't real good. Yeah. But, you really couldn't do this. You could, but there weren't the tools that were available. I mean, right now I can trade online, I can trade options and what have you. And so it became that you have to have an administrator. But when you start taking a step back from it, and once you realize what you were in that audience going, wait a second, and you start thinking about it for a way, you're right, I can be my own trustee and administrator. Why is that? Why hasn't anybody talked about that? Again, because it's not in the best interest of the financial institution. Does that make sense?
It does. Let's go ahead and take a little bit of a step back. So I want to hear a little bit more as far as the journey on the tax lien and the tax deed certificate side. So in your journey while you were a financial planner, you discovered kind of this overlooked way an individual can generate income using tax lien certificates and deeds. Tell us about that journey and how it became your passion to the point that you actually developed kind of an entire education and coaching platform. So, because I know that there are some that are in our listening audience that listen to this, that's part of their journey. They're kind of going through, they've kind of figured something out, and they want to take it and help educate individuals like you did in this particular area, and then you are now, as well as we're going to talk about a little bit further as we get into this podcast. But if you can tell us a little bit about that journey and what that looks like.
Let's go backwards. Yeah, let's do that. So, basically I was introduced to it in 94, I think it was. And I was like, there's no way. You can't get 16% mandated by law. I mean, it's mandated by law, 16, 18, 19, 25%. And it's been around for over 200 years. And as I started to do research, this was actually in Phoenix, Arizona, I'm looking at this, and I got to the point where I think I was driving Elizabeth. She was the county person in that office crazy, because I'm just doing all this research, and understand this is, before all the internet and all that stuff. And so you had to do it physically. And then I started, I bought my first one for like $54, Josh. And I was like, I'm holding this certificate in my hand that says, when the property owner pays these property taxes, I get 16% on my money. If they don't, I foreclose on the property and take a superior position over all liens and encumbrances, including a mortgage. And I'm like, okay, what's wrong with this? And so then I started doing it more. And then, of course, when you have something like this, you start talking about it. And a friend of mine was good friends with a gentleman by the name of Jay Mitten. He was an asset protection attorney out of Utah, was on CNN, Larry King back in the day, and what have you. And, that whole somebody knows somebody who knows somebody, he got a hold of me and he says, I've always looked at this. And I heard you're an expert on tax lien certificates. Now, understand, Josh, I had been doing it for about 90 days at that point. And youth is beautiful because I'm like, oh, yeah, I'm an expert. Yeah. And so he flew down to meet with me and his son. And we spent a couple of days doing this. And he's like, I really want you to teach my clients how to do this. And I said, absolutely. So he flew me out to Los Angeles, and I'm sitting there having dinner with James, his son, and Jay. And he says, so is there anything you need for tomorrow? So what do you mean? He says, I'm good. He goes, well, overheads, what do you need? You got any videos? I go, no. And when he said, I want you to talk to my clients, I thought it was like a room full of people, maybe 10 or 15 people. Well, there were 427 people in that room, Josh. And I had never been on stage before in my life. And I got up there and did my best to educate these people and understand how intimidating this was. They were doctors and lawyers. And afterwards, I got mobbed. And Jay had set it up. So I got mobbed with people I had questions. So afterwards, he smiles and he goes, okay, now I need you to go write a book on this. And I need you to do research. And I literally traveled the whole country, going to auctions, buying liens, buying deeds, because it just set me in a completely different trajectory. After about 4 months of that, I just looked at New York Life as actually holding me back from making money on this. My goal at New York Life was to retire with, $250,000 in income. And this just blew that away. And then, it got to that point where I was, on big stages. We ended up doing a TV show, several books. I got a new book coming out. The Wealth Formula Revealed will be coming out later this year. Just talking about that whole thing. And it just really opened my eyes to something that not only has been around for over 200 years, but really nobody had a system for it. And I think what makes it so unique is every single state has a different version of how you do it. In your backyard there, we've done a ton of stuff. They got commissioner sales. They've got all these different things that you have over there. Well, that's fine and dandy, but you go across the river over there to Chicago, and it's a completely different deal. In fact, one of my first trainings I ever did was in, I think it was February of that was August of 1995. It was a summer you guys had so much heat up there. I spent 6 weeks doing what they call their supplemental sale there, 18% every 6 months, mandated by state law. We get properties. I've got 3 properties right now that I've spent a total of about $127,000 that have about a value of $500,000 right now. I'm doing a little rehab on those and fix those up. So obviously there's some huge gaps in there with profit. And that's how we got to where we're talking about today with the retirement. I mean, what we were playing on this before the flip this house craze came in there, we'd get properties and we'd sell them. And my biggest challenge was I need to wait 12 months to change that from ordinary income to short-term capital gains to long-term capital gains on that. So I've always kept my eye on that. There was ways I wrote contracts to do that. Then all of a sudden I'm looking at this retirement thing. I'm like, oh my gosh, that's a game changer, completely for my financial deal. And it was a game changer for my clients. I'm going to tell you this. Let me tell you why. I'm teaching in like 2010-ish, 2011-ish. And I got people coming up to me, Josh, as you did back then too, that are just devastated for what happened with the whole real estate debacle and the financial meltdown, knowing how long it took them to get to where they were. And they're like, literally, some of them tears in their eyes. I remember this one couple, and they're like, we don't have that kind of time. And I'm sitting there smiling. And the guy says to me, why are you smiling? I said, well, I can actually see where you're going to go. All you can see is where you're at. And I'm telling you, if you capitalize on not only these different strategies that are out there, but also utilizing your retirement account, because that's what it's all about, isn't it? You can get there really quick. And, I'll tell you, I've helped a lot of people find financial independence through different investment strategies that I've been teaching over the years. And literally, I have taught more people on tax liens and investing than anybody on the planet. I've been all over Singapore, Sydney, speaking to, with Tony Robbins, whatever, all over. This right here, teaching people how they can control their retirement account, gives me so much satisfaction because of that whole process. I see these people later on. I just got goosebumps. On Monday, I had a couple call me up, and we were just talking, some clients of mine, and they said, I just got to thank you. We started our retirement account with $2,200 because you almost made us, and you said you can't fund something that doesn't exist. And he says, do you realize we're touching, just not quite there, but we're almost to 7 figures in that account in 6 years. And this is a couple in their 30s. You know what I mean? And that to me is just so, but it's also the other side of this, Josh, is I've seen people, like, even with the tax liens and deeds, why isn't everybody talking about this? There's no commissions in it. There's no, it kind of gets back to that financial deal. There's no commissions. There's no way to monetize the whole tax lien and tax deed market unless you opened up some type of fund, and that sounds like a job. And just like when somebody self-manages their retirement account, there's no management fees. I took over a retirement account for an air conditioning company about 1.5 years ago. Friend of a friend, they referred me. It wasn't like one of these, but I looked at his statement, and they were paying $2,400 a month in management fees for their retirement account. And that's another conversation I get all the time. In 2012, the Labor Department actually had to come out with a new rule mandating that pension fund companies disclose how much they were charging, the management fees on that, which, Josh, as you look at these statements, I know for a fact, Josh, that you are looking at these differently after you and I having the conversation, and you see me back in June, going, wait a second there. Just take that alone. If you were the manager of your own account, now you could leave the funds exactly where they are, but you eliminate that management fees. Why do you have to pay somebody a management fee to fill out paperwork that's 2 pages? You know what I mean? When you're talking 5,500s or whatever you're looking at. So is that helpful?
Definitely. So you had, and so one area that some people don't think about until they really began to accrue wealth is asset protection. And so you kind of, interesting enough, you mentioned you were going and you were speaking for these 400 plus people for an asset protection attorney, essentially. So when we talk about asset protection, there is something a little bit unique when it relates to retirement accounts as it relates to asset protection. So it really does become an issue, is for those of us who are accruing wealth, that now all of a sudden we have a little bit more of a target on our back. And so we have more assets, and then of course, as we have more clients, we're out in public more, the greater the possibility of also having to deal with either a lawsuit or some sort of another type of an issue. So when we talk about retirement accounts, asset protection, and to kind of just throw it over to you, what sort of special types of treatment does a retirement account get when it relates to asset protection?
Absolutely bulletproof. Let's just start with that. I remember when I first started teaching people about this, my attorney was saying, you can't say that. Well, unless you're doing something fraudulent, it's very, very, very difficult to penetrate a qualified retirement plan. So unfortunately, nobody that's listening to this podcast right now ever anticipates having things happen to them. That's the reason. What do they say? The only time you need insurance is when you're sliding down the road backwards on a sheet of ice, right? But, I have got, with the thousands of these that we've set up we've set up over 4,000 of these in the last 7-8 years. There's been a couple incidents where some clients came into some trouble. One in particular off the top of my head is Julie and Bob. They had some medical issues piled up. I call it the medical hammer. This is back in 2013, I think it was. And they had to file bankruptcy. And these creditors, they had a high net worth and good money going in, and also that just caved because of his health issues. And she called me up and she's going, I've got this situation with the trustee, the bankruptcy trustee, and, they're trying to do this and that. And I said, okay, this is what you need to do. Go into your program to pull these 2 sheets, hand them to the trustee. And she did. And she called me later that day. She goes, I don't know what they said because I read them 3 times and didn't understand it. But he read those in about 15 seconds, turned them over, slid them across the table and said, all assets in the retirement account are off the table. To the point where somebody was getting upset about it, one of the creditors, and the bankruptcy judge said, if you mentioned it one more time, you will be asked to leave the room. So the asset protection is just phenomenal in that, and I think that that's the most important thing that somebody can look at. It's not what you think about, Josh, and I'm so glad you brought it up, because most people don't think about it, because that's not what you're thinking about. You're not thinking about, well, what if something bad happens on that? In most cases, it's kind of there and you forget about it. But it's really important to know that all of those assets in there that classic, somebody slips and falls on one of your properties or whatever the case might be, they're not going to be able to take advantage of that.
I tell clients this from time to time, that you'll find out as you kind of go down through this journey of life, but especially in business, if you achieve any sort of level of success in business, it's not a matter of if you will get sued or if you'll face some sort of a legal issue. It's just a matter of when. So it almost, I'm sure you've been sued, Sean. I know I've been sued. It's just kind of one of those things that it's just bound to happen. So to make sure that you're structuring yourself in a way prudently to be able to protect yourself, especially from frivolous. Most of the time, those lawsuits are rather frivolous. You end up just settling or whatever the case may be. But if having something in place to where it provides some protection for you and your family, I think is extremely prudent.
No, it is absolutely, and I agree with you 100%. It's not a matter of if, it's a matter of when.
So let's kind of transition a little bit, talking about retirement accounts. Most people, they either use a stockbroker. Okay, so they go and they get a broker, and they kind of help them in regards to handling their retirement funds. They may use a third-party administrator. A lot of our clients, they have self-directed accounts. So they'll go through and and I have quite a few of them are really good friends of mine that own these companies that are third-party administrators or custodians. So they go and they find these people to help them set up their retirement accounts. Is this truly necessary? I know you kind of answered this question a little bit earlier. And what are the hurdles that one faces when they have to deal with these third-party administrators, with these custodians, as it relates to them having freedom within their account to do what they want to do?
Well, there's a couple of things. First of all, they are the custodian, so there's some fiduciary responsibilities on that. So let's just say you take a third-party administrator and you're not going to a TD Ameritrade or Fidelity where you're locked into their investments. Administratively, you are handcuffed into what they're capable of doing. When you start doing real estate within your retirement account that is administered by a third party, it is possible, but it is difficult. I always called it the second closing. So there's two closings that are going on, and there's all this paperwork going out. And there were several times that I just lost out because I couldn't get it done quick enough, type of a situation. What really irritated me and got me to the point of asking that question that one time, is my retirement was my big hurdle for the next year, was the fact that I did have a rental property with a third-party administrator before I discovered this strategy that we're talking about. And the renter had stopped paying the rent, and I didn't know about it for about 60 days by the time the paperwork got to me. And they were charging me $12 for certain things that were, and I'm thinking to myself, it's not fair, not only to the renter, because now they're 60 days behind if they were 30 days behind, and I could have done something about it, and now they're further behind. The trust, it is just a circle thing. And so there's that problem there. Anything out of the ordinary, holding gold, physical gold, all those things become prohibitive when you've got a third-party administrator, and there's just no reason for it. There's literally no reason for it when you see the simplicity and what's happened. And, we've developed, our Tax Freedom Retirement Club, which is basically teaching people how to be self-reliant in their retirement account. I mean, it can be a little intimidating for some people because there's these big words rolled around: administrator and trustee. It's just you being prudent enough to know what's right and what's wrong inside your retirement account.
Now you've worked now at this point, you've worked with bankers and attorneys to essentially develop a solution. So what is that solution? What does that look like?
So you mentioned banks, and we need to talk about that. This is another thing that we ran into, where there's again, I hate to use the word conspiracy, but it sure felt like the cards were stacked against us. So we got excited about this. Obviously, I got a great relationship with my bank. I went in and opened up an account, and because you are the administrator, so you have to have a bank where this money goes, and it's just titled under your account, your retirement account, whichever one that is best for you. And so that was not a problem. But as soon as I started helping other people do this, the banks would be like, wait a second, you're not going to let us manage the money? And some banks would refuse to open up the bank accounts for these if you didn't allow them to manage the money, to the point, Josh, that Bank of America sent an internal memo out saying, don't open these accounts unless we are managing the money. So we've actually, and this was painstaking. I interviewed so many different banks. I found a relationship with a bank out of Dallas, Texas. Jonathan and Carl are good friends of mine. They own the bank. In a mastermind like you and I are involved in. They were referred to me after much frustration of dealing with different banks. And they're like, yeah, I mean, what do you mean? Yeah, we can do those accounts. Okay, let me give you an example. They go, Sean, we own the bank. If we say we can do them, we can do them. So now they've actually opened up a whole department. We have a white glove system. Accounts are opened up seamlessly and all of this great stuff. So, that is a very important aspect of this. And then the other side of that is the trust documents. I mean, once we figure out, there's about 5 questions, Josh, that we need to figure out of where you need to go. There's not anybody that we've ever found that's like, this doesn't qualify for you. It's just what qualifies for you. And then we can determine that. And then we teach you how to, do the accounts and what have you. And I apologize, but did I answer your question?
Yeah. So let's take it one step, maybe for those who don't kind of understand the concept. So they understand the concept. Okay, I can go to a broker. I can go to a third party administrator. So they understand the concept that, okay, I go to this place and open up this account. But when they hear kind of like, okay, I can be my own administrator, I can be my own trustee. So they can understand, okay, this is the third party administrator, this is a custodian. But can you kind of help maybe define those terms a little bit of what this means?
Yes. So there's 2 things there. There's the administrator, and then you're the trustee. So a 401k, we've all heard of those, but let's define what a qualified plan is. An IRA is not a qualified plan. Okay, anybody can do an IRA. My 7-year-old daughter has an IRA set up. Okay, there has to be a third-party administrator, and there has to be a window of what you can invest in. Period. Okay, that is not a qualified plan. Everybody on this call right now knows what a 401k is. 457, 403b, SEP, KEO, whatever. Those are qualified, which means you have to qualify for that. And so what that means in this case, probably 85, maybe even 90% of our clients that come into our retirement world are going to be setting up a trust document that's 401k, where you are the trustee, which means you make the decisions on the rules of what you can do. And you're the administrator, which means basically you're doing an accounting of what goes in and what goes out. That's it. So what we do is we establish, okay, Josh, you have this business. You want to have that business sponsor a retirement account. Like, let's say, I don't know, Apple Computer has a retirement account. They sponsor a retirement account. But as a business owner, you say, yes, I want to sponsor my own retirement account, and you can do that. So you sponsor this retirement account. We set up the plan with that. We set up the trust. We show you how to set up the bank accounts, and you're off to the races. Now, as far as funding it, there's 2 ways, just like there is anything. It's no different than I don't want anybody like we created something. All we did is said, wait a second, let's eliminate the administrator and the trustee and make it you. And so what happens at the end of that year, Josh, is, we look at income, okay, based on your income and based on what you've done, boom, boom, the calculations of this is what you can contribute. And let's say you're, 40 years old and you're making good money, you could contribute as much as $60,000 into this. And as you know, Josh, that's a direct reduction in taxable income on that. Go from there. If you're married and both of you are working within that organization, double that. And there's catch-up contributions and stuff like that.
Awesome. So someone goes ahead and they move forward. They say, okay, I want to go ahead and set one of these up. Now the big question is, okay, what can I do with these retirement funds? Because, for years, it was always kind of like people just think like, okay, well, retirement funds, I'm going to put it into the stock market. Okay. Or I might diversify and buy some bonds or whatever, so I kind of have this mix into my retirement account.
Right.
And you have other people, they're familiar with self-directed. Okay. So I'm going to lend it, or I'm going to buy real estate with it. And so that's about the extent. And even with most of our clients, that's kind of what we hear. They're kind of just fall within that pretty narrow area. But there are other things that they can do. And a lot of people, they don't do other things because they're kind of nervous or they're scared that they might mess things up. So what essentially can someone invest their retirement funds into?
Okay. So with this setup, the way I like to say it is this: pretty much any investment you want, as long as you're not physically benefiting from the investment. Josh, you and I can't go buy a vacation home and go hang out in it in my retirement account. But I can buy an Airbnb and put it in there. I can buy physical gold. I can trade options if I feel that's good enough for me. I can do Forex trading. I can, whatever.
Crypto? That's a big thing. That's a big question I'm getting asked now.
I was just going to get to that. Cryptocurrency. So I've got a lot of the groups that you and I belong to. I'm getting hammered with that. They're like, dude, I'm getting killed in taxes on this. I'm going, yeah, why would you not do this in your retirement? I've got hundreds of thousands of dollars in crypto in my retirement account. And it, Coinbase, you go in there, you open up the account. I'm the administrator. I'm the trustee. I give them the tax ID number like a business. The account's opened up. I fund it with retirement money, and I'm off to the races. Here's another thing. You can't do this unless you set it up this way. And I know a lot of your clients are real estate people, Josh. Is it okay if I get a little advanced here?
Of course.
Yeah, this is almost retirement on steroids, if you will. Let's say that you, Josh, own a property worth $400,000 in your retirement account. Let's say it is paying, some income on rental and what have you. And you own it free and clear because in your retirement account, you've done a good deal on that, whatever it is you did. And all of a sudden another deal comes along and you and your wife are looking at it and going, God, that'd be a great deal for a retirement, but we have no liquid cash in there. You have a $400,000 house in there. Because you're the administrator and the trustee, and only because of those two things, you're allowed to leverage assets within your retirement account. So what you can do is borrow against that property that's in your retirement account. Let's say you find a property that needs, you can pay $200,000 for it. Let's say it needs $50,000 worth of rehab. So Josh, you buy it for $200,000, you do the rehab on it. It's a great deal. You sell it, you flip that property for $350,000, and there's $100,000 profit. Well, here's the beautiful thing. Because you used an asset to leverage the loan to buy that property is considered an asset of the retirement account. So you pay the bank back the $250,000, and the $100,000 profit goes right back into your retirement account. No short-term capital gains to worry about at all on that. That is insane, because literally you're almost, what's your return on that? Kind of infinite, because you use borrowed money to get it. You made $100,000 on the deal without anything outside. You didn't have to have extra capital in there or anything. And it almost deserves a moment of silence when you hear that, because I know what happens when I'm doing conferences and people come up to me afterwards. They're going, like you said at the conference, are you sure you could do this? And, it's right there in the ERISA code and all this, that you can do this stuff. So I always like to say this. If you have to ask, I wonder if the IRS would allow this investment in my retirement account, you probably shouldn't be doing the investment. But the real basic deal is, if you're physically benefiting from the investment, it's not allowed. You can't buy a property for your son, Ben, or do that way. You can't do that. If you're a car collector, you bought a 57 Chevy and fixed it up and sold it, that's allowed. Buy a 57 Chevy and drive it in the parade, that type of. So it's pretty basic. And again, I know that we've talked about this before. A lot of common sense comes into this, And one of the things that we've done with the Tax Freedom Retirement Club is we put videos out on this, and I'm constantly, anything that happens in this arena, I'm doing videos on this, any articles, anything that comes up to kind of keep you abreast. And I'm going to talk about this. This is what I found with this. And you know this as a CPA, that gets measured improves. That gets measured and managed improves dramatically. And it's a really weird phenomenon that I've seen with people that start managing their own retirement account. They pay more attention to it, Josh. You know what I'm saying? So they're looking at this and all of a sudden they go, oh my gosh, I can do this and I can do this. And the other thing is independent financial advisors are coming to me and saying, can you set this up for my clients? Because it makes them look like heroes. If they go, sometimes, Sean, something comes up that I'm not even allowed to do that because as a fiduciary, I wouldn't be allowed to let them do that. But when they're the administrator, they can. It's just, you can hear it in my voice. I get so excited about this, John.
So if someone goes and they set this up, what responsibilities do they have? So you're going to help them. As far as on the education piece, even as far as on that. So when they walk through this process, but what sort of responsibilities do they have? You mentioned 5,500s earlier. So what other sort of responsibilities does the individual have?
Well, there's not a whole lot of responsibilities in the beginning until you get to a certain level, and remind me, and I'll get to that. So when you first open up, it takes us about 72 hours really to get these things rolling. We were just buried at the end of the year last year doing these. I think we did 150 plans in the last 2 weeks because people were trying to get in for the 2021 calendar year. And really all it is there's about 6 different signatures on the trust documents, and you've got to do some basic stuff. Set up the bank accounts, which we will set you up with our contacts over at Titan. Ryan and those guys, they white glove you. They put you through the whole process. Now you've got the accounts and you roll your money over into that. That's a responsibility in the beginning. If you need to do asset transfer, you can do that also. We'll show you how to do that. Basic things. Beneficiary. If something were to happen to you, you've just got to name a beneficiary. That's probably one of the biggest things you've got to do. That's it. Now, as you get rolling, obviously this bank account has to be, you've got it in an accounting software system. And at the end of the year, Josh, you're going to ask them, we need your bank balances. We need your bank balances and what assets do you own and what are their values? Those 3 things is all they need to tell you as an administrator. And so, I've got $100,000 in cash and I've got $80,000 worth of asset. Okay, that's it. Now, once the plan gets a value of $250,000 or more, you have to file, which you're familiar with, Josh, is the 5,500 form. And I haven't looked at those for a while, so you can probably better answer this question. It's about 2 pages. And it basically just says, now, this is another beautiful thing about the self-administered plan. When you file your 5,500, okay, that puts a timestamp on your plan documents. The IRS can't go back and audit that after 3 years. So once that clock starts ticking, not that you're doing anything wrong, but if anybody knows their history with the IRS, they have gone back and changed rules and said, we're not going to do that anymore. Okay. Not that this has been around for years, but hey, peace of mind. So once you stamp that with the 5,500, so anytime your assets get above that, and Josh, you can help them out with that. They make that happen, but that's really it. And so because like a lot of times we get, literally I was with an attorney. We're doing about 300 people up in Coeur d'Alene, a conference up there. He's a corporate attorney. And he goes, it just makes me so angry. He says, I talked to somebody the other day where and I will not name the financial firm. They're saying, you're not allowed to manage your own fund. And then made it sound so complicated. And what we just talked about is really essentially it. If you can balance a checkbook, you're in.
Awesome. There's been a lot of talk about setting up an LLC and having a checkbook IRA. Okay. Which of course, in recent days has really drawn the attention of the courts and Congress. So is having a checkbook IRA a good idea? And how does becoming one's own custodian and trustee differ from having a checkbook IRA?
Great question, Josh. And I'm so glad you brought that up because it's a hard, sensitive subject to bring up because people come to me and go, I've got check writing IRA. I go, you're asking for trouble, period. And it's coming. It's starting to happen right now. You might be referring to that Wall Street Journal article from last month, which I'm doing a video on. If you want, I can send it out to your clients. But it's, the IRS is coming down. They're just saying, no, you can't do that. It's, how do I put this? Well, actually, you can appreciate this, Josh. One of my best friends is a CPA. And about 18 years ago, we were sitting there talking, and he goes, Sean, you're always looking for ways to get around the IRS. And you got to understand something. My dad was an entrepreneur. He was the youngest of 11 kids. They both, my mom and my dad met in Nebraska. They both were raised on farms. And so they kind of got that whole mentality, if the IRS is knocking on the door, grab your gun and then ask questions, type of a deal. And that's kind of how I was brought up. And I says, well, yeah. And he goes, there are no loopholes, Sean. You got to understand the IRS just sets up the enforces the rule. Think of them as referees. He says, Congress is the one that's making the rules, and they make the rules for you to win. You not knowing that you can punt on 4th down is your problem. He says, you need to understand the rules so you can go with it. I'm like, okay. The rule is very clear that you cannot do what they're doing with these check writing IRAs. Now, there hasn't been an IRS ruling on it yet. It's coming. I'm telling you, it's coming based on what happened in Congress several months ago with that. Can't remember what his name is, but that brought the attention of everything. And I knew it was just a matter of time before that happened. So I've dealt with this question for about 8 years now. And, my thing is, do what you want. I'm going to do what's in writing. Anybody here can open up and become a trustee and what have you. Let's put it this way. This is what all senators and Congress people get. They get their own qualified retirement plan. So there you go.
Okay.
That makes sense?
It does. All right. So let's, so tell us a little bit about prohibited transactions and what should some practically do to make sure they avoid any prohibited transactions.
Well, again, I want to go back to the whole, if you have to ask the question, I wonder if this is prohibited, you probably shouldn't be doing it. It's so limited on what you can't do. So you can a prohibited transaction, if I wasn't the trustee, would be cryptocurrency, Forex trading, all of those, because, that does not meet the widow and orphans rule, if you will, as a, I can't take somebody else's money and do that. Because you're the administrator and the trustee, I can go out and do an Airbnb if that's my deal. I've got a group that that's all they do. And so they teach people how to do multiple houses, and you guys should be doing some of these inside your retirement account. You can buy gold and keep them in your safe wherever you want, a physical gold. You can do all these things. So, it's really is limited on what you can't do. What you can't do is be physically benefiting from it. So that Airbnb, I better not be using it. So again, it becomes practical on that. And I'm hoping that helpful. We got a whole slew of information on that to make it happen. But the prohibitive transactions really comes into play when you are not your own administrator and when you are not the trustee. And prohibited transactions go into a fiduciary thing more than anything else. So I cannot do something that's going to physically benefit me.
That's helpful. Thank you. No, so I'm going to go ahead and throw a question over to you. And it's one that I ask pretty much every time I have somebody on the podcast. So it has nothing to do with retirement accounts, although your answer may have something to do with retirement accounts. But you've worked with hundreds of entrepreneurs, solopreneurs, everywhere from a solopreneur trying to figure things out all the way to very profitable 7, 8, 9, 10-figure business owners. From your experience, what are the top reasons why a business either succeeds or fails?
Oh, gosh, that's actually a pretty fun question. Top reasons they fail is lack of planning. And number 2 would be lack of understanding of financials. And I'm not kissing up to you, Josh, but it's the truth. I know I see more people that don't understand. They're just trying to make money. And making money doesn't mean you're profitable. I've seen this time and time again. Growing for growth's reason alone is not true. Understand what APs and ARs and how they can affect your balance sheet. Understand where your COGS are. Understand that you have to reevaluate that on a regular basis. And if you're not having, regularly scheduled meetings on looking at your financials, you're making a big mistake, and you need to question your paradigm too. I'm going to tell you this pandemic really taught me a lot. Everything that we were doing went away. And so we were forced to think of things differently as far as, virtual, like we're doing right now and what have you. And it also got rid of some sacred cows, things that we thought were not possible all of a sudden became possible. So sometimes I think you need to question what it is that you're doing, but by far, what makes a business fail is a lack of vision and plan on where you're going rather than trying to look at what's happening right now. So there's two different things. As an individual, spiritually, we're taught to be in the present moment, aren't we? Right? Be present, be present, be present. As a business owner, yeah, you got to be present in your business, but you better have a vision on where you're going and know your numbers. Know your numbers. And if you do not understand financial balance sheets, then learn them, please. And I tell this to kids that come to me all the time and say, I'm thinking about going to school. What would be the best subject for me to teach? Finances, period. I don't care what it is. Nobody that's going to school can't benefit from understanding. I don't care if you're opening up a hair salon, car wash, to whatever the deal is. If you understand how that works, that revenue is not profit. EBITDA doesn't mean anything. It's an interesting number. I always like to say above the line, below the line. What are your yagas that really don't mean anything to run the business, and what's your bottom line to make it? And it also sets the stage for things. If you understand where your cogs are and where that's going, you understand how hard to work.
There's a lot of vanity numbers out there that people like to throw around. I see it. You see it all the time on social media. I saw one here within the last couple of days. My company made $1 million this last year. They're in real estate. So what does that mean? You sold 4 houses. Congratulations. It's stuff like this. They're meaningless numbers. And of course, as an accountant, I see that, and I just kind of half roll my eyes. The other one that that kind of irks me a little bit is the whole cash flow. And I say, okay, well, that's great. There are businesses losing tens of millions of dollars that have all kinds of cash flow. And I jotted down this line this last week, and I kind of think I mentioned in my last podcast. I mean, there's very little difference between a business with no cash flow and one that doesn't manage their cash flow. You talked about not knowing your numbers, that type of thing. And as an accountant, and generally we work with clients, the income statement is actually the last of the 3 financials we look at. We really dig into the balance sheet and the statement of cash flow.
Balance sheets,
before we get into the P&L side. So thanks for sharing that. So as we wrap this up, Sean, and thank you for spending the time, and you gave us an incredible amount of information, but I do want to offer the opportunity of anyone, if they want to get a hold of you, to be able to do so. So if someone's interested in doing this, first of all, if you can kind of give us an idea on the kind of what does this look like from a cost perspective, because, and it's kind of one of those things that I know from a tax perspective, someone going, they're setting up a qualified plan. There's actually a tax credit out there they can receive to get help with this. But I think probably for anyone, just the fact that I'm not going to have to pay a custodian, bottom line, by definition, I'm going to make between 12 and 25% of my money if I did nothing. I've been doing the same thing in this structure as I would doing someplace else. So it's almost a no-brainer. But someone has that question, what does that cost look like on the front end? And then how do they go about it? You mentioned kind of these 5 questions they can answer. Is there a place they can go kind of complete that and connect with you or your team and then decide if they want to move forward?
Absolutely. And a great question. The cost on this is not a one shoe fits all. So let me give you an example. I'm going to say probably 85% of our clients will roll in the like $2,500 range for that. And then it can go as high as $5,000. And that's really it. And I really appreciate you bringing that up as a CPA. There's a big deduction for setting this up right off the bat. Number one. Number two, as you contribute funds to this, I mean, there's that whole adage, you either pay the IRS or you pay your retirement account. I mean, my CPA to this day with my own retirement account sends me a note, text message every single year. We got 2 choices. If you fund your retirement account, this is how much you can. If you don't, this is how much you have to pay the IRS. And he does it for fun because he's the one that helped me set this whole thing up, but it's the truth. There is a link that I've got set up specifically for your people on this. And I want your students to know that this is a very simple process. So you go to qrpcall.com. That's Qualified Retirement Plan. So qrpcall.com. I've tried to make that as vanilla as possible, meaning there are 5 basic questions in there. And what that does at the end of those questions, you will have an opportunity to do one-on-one with my staff, and understand they've been with me, some of them for over 15 years. They know what they're doing. And in that call that you will have the opportunity to go, okay, this is what you're going to be able to do. Here's what you need to do to make this thing happen. And I don't care what your circumstance is. This is a very unique opportunity. I haven't seen anybody that doesn't benefit from setting this up, Josh. I mean, like you said, it's a no-brainer on that. Not only is there the deductibility in some of the plans, not all of them, but some of them, when you first initially set it up, there's also the contribution levels and then your awareness of it. I mean, it just goes on and on. And here's the other thing. It's the gift that the IRS keeps giving. So every year you get those deductions. And you don't have to pay us every year to set this thing up. We do have an annual fee of $197, and that's just to keep us going with all the videos. And we have a white glove experience, which means you can call us anytime with questions. We have a personal relationship with the bank. Let me explain how valuable that is. I was doing a deal in Savannah, happened to be in Dallas speaking. I called Jonathan to see if he wanted to have dinner. He's the owner of the bank. Coincidentally, I was leaving Dallas to go to Savannah to an auction. He calls me up later that afternoon. I go, when any can't make it, what's it? He goes, Sean, you're requesting some cashier's checks to be overnighted to Savannah. And I go, yeah, I'm going to an auction. He goes, we can't send checks to an address that's not the address of record on the plan. He goes, tell you what, though, just tell me what it's for and give me a couple of descriptions of these houses and I'll put it in your file. They're regulated. They're regulated. I went, okay. So we went out to dinner and he says, Sean, talk to me about this. So I told him, I said, look, I can't possibly know what I need as far as dollar amounts, a week or so out. So that wasn't going to work for me. And he goes, yeah, we get a lot of those calls from your clients. He goes, let me work on it. 30 days later, he got a special permission from the regulators for our clients to be able to send cashier's checks to anywhere they needed them. That's the kind of white glove that we have on that. We have conferences that we put together once a year with speakers that come in. What I want you involved in is the tribe of the Tax Freedom Retirement Club. So that you're part of that and you see what's available to you and you take advantage of it. I've just seen this explode. So when you go to qrpcall.com, all you need to do is answer those questions, set up an appointment with my staff on there. They'll give you 30 minutes. And in that 30 minutes, you will have a direction on where to go. And I think it'll change your world. It really will.
Thank you, Sean. I appreciate you doing that for those who listen to this podcast and for our clients. And I think probably for many of them will end up becoming mutual clients at some point as well. So
absolutely.
I appreciate it. Sean, thank you for your time today. I cannot express my appreciation enough for you. You're a very giving person, and that I've noticed, and I'm thankful for that. Once again, for those of you that are listening, this is Josh Belk with Belk on Business Podcast. If you haven't already, please consider subscribing. Definitely look in the show notes. We'll go ahead and put that link for qrpcall.com, where you can get a hold of Sean and his team, answer those questions, and get the ball rolling on investing in your future and getting it done quickly. Thank you much. Have a wonderful day.